have for us today?
A fishbowl full of SAE questions.
Hi, I'm Rahul.
Hi, I'm Komal Narang.
Komal, interestingly and very different from what we usually do, we have a fishbowl in front of us.
Well, I see a few questions in there. Let's dive in.
Let's take the first question. What is a systematic active equity portfolio?
A systematic active equity process uses a lot of quantitative models. It is backed by large-scale data. It depends on behavioral insights, and it factors a lot of advanced risk controls rather than just do the bottom-up stock picking. If I was to define in one line, Rahul, the objective of SAE is to capture little alpha across many investment bets rather than depend on few investment bets to generate a lot of alpha for you. And hence, this approach is risk-aware, benchmark-aware.
Lovely, Komal. I think that's a brilliant start to what we're trying to achieve here. Let's get into the next question. Okay, what are the key features of a systematic portfolio?
So let me first give you the key differences. And I think there are 4 features based on which I'll try and explain SAE to you. The first and the foremost feature is that decisions here in SAE are based on data and a lot of model-based approach which is predefined.
Okay.
This is contrast to how an individual would take a view and then take decisions. So fundamental says I would have a fund manager making a view on a stock and then take calls to build that into a portfolio, versus that SAE would depend on data, insights, model, and through a process get guided to build a portfolio. Number 2, we are saying that the portfolio here is dynamic, which means that you would see rebalancing of portfolios happening very, very frequently. Because over here, we are seeing fundamentals, valuation, sentiment, and many other signals that are evolving on day-to-day basis. The portfolios here receive signals on everyday basis, and based on that, a portfolio manager can take decisions.
So it's more dynamic. What you're saying is, the portfolio churn, so higher churn for a portfolio is good for a systematic strategy.
That's
so
right.
1 and 2. Let's get into number 3, Komal.
I'll bring the third point. Risk is analyzed and calibrated with an exposure to a sector or a stock. Most of the portfolios that are created using SAE are aware to the key features of that fund. For example, when we launched the JioBlackRock FlexiCap fund, that portfolio is aware of the risk at a stock level. Today, when we are launching a new fund offer of our systematic approach-based sector rotation fund, this would be risk-aware to the sector. While the umbrella strategy is same, but we do see that based on what the fund has to deliver, the risk is evaluated in comparison to what the strategy of the underlying fund is. That's core to SAE. And the last and not the least, which I kind of mentioned earlier, and I'll reiterate it again, is that in SAE, you would see a diversified portfolio because the idea is to capture alpha from these smaller bets rather than capture a very large alpha into a single stock. So these are the key 4 pillars on which SAE approach is based.
So, Komal, why don't you take the next one?
Oh, of course. That's amazing. Okay, so with this question, Rahul, we are actually peeling it a little further. How do you think investors should not view SAE? And let's break a few misconceptions. The first misconception is that why did the portfolio sell a stock that it had just bought?
Brilliant question, Komal, and I think this brings out a very important point that systematic models adapt as signals change and new information is incorporated into the process. The model factors in information considering multiple attributes to calibrate positioning, sizing within the portfolio. For example, why don't you give us an example, Komal?
Yeah, very interesting. So what happened was that when our portfolios got printed, it was analyzed that we were underweight on a particular stock. And rightly so, because our signal said, based on the management commentary and the analyst report, the signal kept the score at an underweight for that particular script. As we progressed in a week, the valuation signal or the valuation data backed that stock such that we went overweight on that particular stock. So it's that dynamic. And as I said earlier, There would be many more examples like these where portfolios would see rebalancing and churning far more frequently.
I think that's a very interesting point, Komal, because when you think of, when you look at a portfolio, you're looking point in time. You're looking as on that particular
right.
date, what is this? But what you're saying is that over the month,
Yes.
there can be instances when you were overweight that stock, then underweight. You captured that small alpha, moved out of it, moved back into a different security, for example. Very interesting.
Second misconception, why do we have so many stocks? Like when our FlexiCap portfolio came out, 120, 140 stocks, and that's a range that we had always asked. And we were doing exactly what we had said. But why do we have so many stocks? And the second question that emanates from that is that then the weight to your top holding is very small. How do we address that?
Yes, Komal, so I think, like you rightly said, we have a lot of stocks because that is our objective. The more number of stocks our portfolio has, it gives me as an investor comfort that the systematic process is working.
True.
Now, the idea of a systematic portfolio, like we've been talking, is to capture small alpha across a large number of stocks. Yeah. So one, we need to have a view on a lot of stocks. So when you think about us, we start at 1,000 stocks, then come to 750 stocks, and then finally create a portfolio of 120 to 140 stocks, like you mentioned. Yeah. The second point is that when you think about how the strategy works, goes back to what I was saying earlier. If we want to capture small alpha across a large number of stocks, we will be a benchmark aware strategy. We will deviate from the benchmark in very small percentages, which is where when you look at what are few matrices such as, what is our active weight on a particular stock, that's how much are we deviating from the benchmark, it's going to be very controlled. Yeah. So I think the point that we have a lot of stocks, the point that in each particular security we are not deviating too much, helps us capture that small, it helps us deliver what we are saying, that is capture small alpha across a large number of stocks, and don't build a portfolio which is dependent on a particular stock, sector, factor by putting a lot of risk or a lot of deviation in that particular security.
Super interesting. And since you mentioned these two matrices, that the active risk that we are going to take and how much are we going to deviate from the benchmark, should we even give a guidance in absolute numbers that how we are looking at these matrices?
Sure, Komal. So I think when you see our fact sheet, right, and I think we have 3 months of portfolio notes out, very simple calculations. You can see that at a stock level, we do have caps. So we do not deviate more than a particular percentage at an individual security level, at individual sector level, based on what the strategy is. Secondly, when you look at the active risk of the portfolio, we are trying to run the portfolio at a risk of between 2 to 4%.
That's right.
And when you look at the active share of the portfolio, we are running that somewhere between 50 and 55%. 50-55%. And that's good, right? Showing that we have an active share of these numbers shows that we have an active view on a large number of stocks.
True.
And we're trying to capture those small alphas by these deviations.
Great. Rahul, why don't you take the next one?
Sure, Komal. Okay. Komal, let's go over some key matrices one should focus on while evaluating a systematic portfolio. Let's start with portfolio turnover.
Great. I think one of the way of evaluating an SAE portfolio would be that higher the portfolio turnover, better it is, which means that the model is performing. And I think all this time we have been trying to communicate that this helps us capture smaller inefficiencies much in time. You would see a very high turnover for us in our JioBlackRock FlexiCap fund. That's only adding to the process which we had committed. You would see a slightly lower portfolio turnover in our sector rotation fund, but that's how the design of both these funds is. Underlying fact, a higher portfolio turnover only assures you that SAE process is working.
Got it, Komal. And this is where it gets interesting, because when we think of portfolio turnover, we think that okay, maybe the stock is not giving me, or my stock view keeps changing, which is what happens in systematic. So if the process is working, there should be a higher turnover. Very interesting. And very different from a fundamental approach.
Exactly.
Komal, let's go over the next one. What is your view on stock count? I know that you've been saying breadth can drive alpha. Why don't you elaborate on that?
Great. I think that's the design of the fund. The design of SAE is that all our portfolios would have 120, 140, 160 stocks. FlexiCap, JioBlackRock FlexiCap has been ranging between 120 to 140 stocks. Sector rotation fund would have possibly even higher number of stocks. And that's what the core of this portfolio is, that it should also kind of give a conviction to the investors that today we have a capability to have research on those many number of stocks, that the breadth of exposure that adds to the portfolios. And that adds to A, diversification in the true sense, that they have access to so many stocks at that level. And hence, one of the way of evaluating that investors should not look at is that what are our top holdings. Now, this is again a very divergent view from what typically our parameters of evaluation would be, that given that we are saying the strength of SAE portfolios is the breadth of the portfolios, the yardsticks of what are the top holdings, what is the weight per stock, somehow don't hold true for SAE.
Interesting, Komal. So I think what you're saying is that we need to, when you evaluate a systematic portfolio, the higher the number of stocks, the better it is, because
That's
your
right.
objective is to capture small alpha. I think we keep coming
We
back
keep
to this
coming back to
point,
this, yes.
but I think it's essential because that's how it's designed.
Yes.
And I love the point you brought out that, you know, this inherently
Yes.
helps us control risk.
Yes.
Where one particular stock is not contributing to the huge alpha, or, you know, it's not
Absolutely.
like the portfolio's performance is not dependent on a single security,
Correct.
sector,
Correct.
factor's performance.
And if I may just add one more thing here, Rahul, how it reflects in the performance of a portfolio at times is
Yes.
that investors would have to see the impact of these calls over a period of time. And hence the longevity of evaluation of performance is very important. Many a times, a way of generating alpha is also to be consistently quartile 2 or the bottom of quartile 1, so that that compounding itself brings you at the top of the quartile 1 over a period of time. But for that, there has to be a patient investing that would evaluate the performance of SAE portfolios over a longer period of time rather than in a very shorter phases and intermittent phases.
Fascinating, Komal. I think, again, very, very, very different from
Yes.
what's existing in markets today.
Yes, yes.
Okay, Komal, let's go over the third metric. Sector and factor exposure should be aligned with the nature of the underlying strategy.
Yes. And this is where I think we should maybe stitch and summarize all that we've been saying so far. And now that we have an example of two funds to speak about. So there is a JioBlackRock FlexiCap fund, which is a market cap based strategy. And SAE process helps us do a bottom-up stock view in that particular portfolio. The same umbrella strategy, when I was to look at for a sector rotation fund, SAE would look at taking sector-specific top-down calls.
Okay.
So bottom-up stock calls, top-down sector calls. This is how these two are complementing strategies. And investors who have invested in FlexiCap can actually complement by having one more fund, because both the funds are going to be divergent in terms of performance, behavior, portfolio creation in that way. Sector rotation fund would use SAE to express views on sectors by being overweight and underweight in them. And what it enables through the SAE process for investors is that you can, instead of choosing a sector for yourself, can actually rely on a process and a fund manager under the mandate of that fund to do that and navigate for you.
Very interesting, Komal. So I think that although both funds lie under the systematic umbrella, one is bottom-up and
Yes.
one is top-down. One
Yes.
is specific, stock-specific alpha, one is sector-specific alpha.
That's right.
And that's how investors should, like, that's something you keep in mind when you evaluate a systematic portfolio. What's the mandate, and is that fund accordingly performing?
True.
Okay. Komal, I think we have time for one more question. Would you like to take it?
Sure. I guess it's a finale question. Rahul, what do you think drives performance in a systematic portfolio?
Interesting. Komal, so when you think about the alpha sources in a systematic portfolio, they're usually driven by 1, fundamental, 2, valuation, 3, sentiment, 4, quality and stability, 5, price behavior, and all of this is risk control. So when you look at our investment process across strategies, we follow an ARC model: alpha, risk, cost.
That's right.
So anytime before we make every investment decision, we have a view on each of those particular stocks or sectors. We have a risk model that goes into the optimizer, and we have a transaction cost model that goes in. And all of this helps us generate alpha for our investors.
Great.
Closing remarks, Komal?
I think this was our little effort to explain to our investors in a very simplistic way that what are we trying to do in SAE. Please do understand that SAE is a very different approach from what we are currently familiar with in terms of a fundamental style of investing. SAE, over a period of time, will get more funds through JioBlackRock's franchise, and we'll continue to launch strategies. But the umbrella style of investing, SAE, is something that will continue to bring more education, more knowledge, more content on, so that all of you feel more familiar, more confident investing with JioBlackRock. Thank you.
And I think to our listeners, do visit our website, www.JioBlackRockAMC.com, for more information.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.